This is TechCrunch. Well, the data is out, and as Dominic Midori Davis from TechCrunch writes, AI startups accounted for 41% of the $128 billion in venture dollars raised by companies on Carta last year, a record high annual share. In a sense, though, we knew that. Investors last year were voracious in deploying capital to AI startups, to the point that 10% of startups accounted for half of the funding. Those startups included Anthropic, OpenAI, and xAI, which raised double-digit billions last year at sky-high valuations. Actually, they are still raising at an even more astounding velocity. In January, xAI raised a $20 billion Series E. In February, OpenAI snagged a $110 billion round, one of the largest private rounds ever raised, bringing the company closer than ever to a $1 trillion valuation. Size-wise, in between OpenAI and xAI was Anthropic, which raised a $30 billion Series G last month at a $380 billion valuation. OpenAI and Anthropic accounted for a heavy chunk of the $189 billion in global venture capital raised last month, and alongside xAI have teased IPOs for later this year that have investors foaming at the mouth. The state of the venture market is now K-shaped or bifurcated, in which capital remains concentrated in a select few firms that then back a handful of companies, while everyone else is, well, just kind of there. Peter Walker, head of insights at Carta, told TechCrunch, while funding rounds have gotten slightly harder to raise, the capital for each round has increased. So, fewer bets, but more capital. AI startups are raising bigger rounds not because they have lots of employees, they don't, but because the cost of running AI models is high. The latest Carta data also shows that funds raised in 2023 and 2024, after the launch of ChatGPT in late 2022, have posted the highest internal rate of return compared with the declining IRR of funds raised between 2017 and 2020. The report views the increased IRR over the past few years as a positive indicator for the funds backing some of the leading startups emerging from this AI moment. Walker said it is promising that the younger funds have seen IRR start strong, and he added that there were a few factors to consider. For one, he said newer funds might look like they are doing well on paper because if they invested in a seed round, for example, and that company went on to raise a Series A at a higher valuation, then on paper it looks like the investor made high returns in a short time period. This pushes IRR up. It is also likely that the portfolios of the more recent vintage funds are full of AI-native startups in a way that the portfolios of 2021, 2020 funds are not. Time will tell if this early enthusiasm will translate into real returns for investors via exits like blockbuster IPOs or big-dollar acquisitions, or if we are merely in the hype phase of a bubble that will eventually pop. Well, an anonymous Substack post published last week accused compliance startup Delve of falsely convincing hundreds of customers that they were compliant with privacy and security regulations, potentially exposing those customers to criminal liability under HIPAA and hefty fines under GDPR. As TechCrunch's Anthony Ha writes, Delve is a Y Combinator-backed startup that last year announced raising a $32 million Series A at a $300 million valuation. On Friday, the startup attempted to refute the accusations on its blog, calling the Substack post misleading and saying it contains a number of inaccurate claims. The Substack post is credited to Deep Delver, who described themselves as working at a now former Delve client. In response to emailed questions from TechCrunch, Deep Delver said that they and their collaborators chose to remain anonymous out of fear for retaliation by Delve. In their post, Deep Delver recounted receiving an email back in December claiming the startup had leaked a spreadsheet with confidential client reports, while Delve CEO Karun Kaushik apparently assured customers in a subsequent email that they were in compliance and that no external party gained access to sensitive data. Deep Delver said they and other customers had become suspicious. They wrote, having the shared experience of being underwhelmed with the Delve experience and having the overall sense that something fishy was going on, we decided to pool resources and investigate together. Their conclusion? That Delve achieves its claim of being the fastest platform by producing fake evidence, generating auditor conclusions on behalf of certification mills that rubber stamp reports and skipping major framework requirements, while telling clients they have achieved 100% compliance. Deep Delver went into considerable detail about those claims, accusing the startup of providing customers with fabricated evidence of board meetings, tests, and processes that never happened, then forcing those customers to choose between adopting fake evidence or performing mostly manual work with little real automation or AI. Deep Delver also claimed that virtually all of Delve's clients seem to have gone through two audit firms, Accorp and Gradient, which they described as part of the same operation, one that operates primarily in India, with only a nominal presence in the United States. Those firms, they said, are just rubber stamping reports that are generated by Delve. As a result, Deep Delver said the startup inverts the normal compliance structure. By generating auditor conclusions, test procedures, and final reports before any independent review occurs, Delve places itself in the role of both implementer and examiner. Now, this is not a technicality. It is a structural fraud that invalidates the entire attestation. In addition to accusing Delve of misleading its customers, Deep Delver said the startup is helping those customers mislead the public by hosting trust pages that contain security measures that were never implemented. Deep Delver said that while their company was discussing its issues with Delve, the startup sent multiple boxes of donuts to keep employees happy. Nonetheless, Deep Delver's employer supposedly unpublished its trust page and no longer relies on the startup for compliance. Delve responded to the accusations by saying it does not issue compliance reports at all. Instead, it's an automation platform that ingests information about compliance, then provides auditors with access to that information. The company said final reports and opinions are issued solely by independent licensed auditors, not Delve. Delve also said that its customers can opt to work with an auditor of their choosing or opt to work with one from Delve's network of independent, accredited third-party audit firms. Those auditors, the startup said, are established firms used broadly across the industry, including by other compliance platforms. In response to the accusation that it is providing customers with fake evidence, Delve countered that it's simply offering templates to help teams document their processes in accordance with compliance requirements, as do other compliance platforms. The company said draft templates are not the same as pre-filled evidence. Delve added that it is actively investigating any leaks and is still reviewing the Substack. When asked about Delve's response, Deep Delver told TechCrunch that they were baffled by the laziness, clumsiness, and brazenness of it. That's all for now. For more stories like these, go to TechCrunch.com.